Welcome back to the Financial Autonomy Podcast. My name's Paul Benson, financial planner and practice principal at Guidance Financial Services. This week, perhaps a little bit of a controversial one, but one that's certainly topical. Is it time to own Bitcoin? Diversification benefits our portfolios, optimising the return at a given level of risk. Poor diversification can mean you're taking on risk without being appropriately rewarded. It is possible to over-diversify. A portfolio with 1,000 stocks doesn't significantly reduce your risk compared to a portfolio with 500 stocks, assuming similar geographic and industry allocations. When constructing a portfolio, we're looking to combine assets that don't move in lockstep with one another. The jargon term for this is correlation. An example at the individual stock level would be someone owning Woolworths shares won't see a lot of diversification benefits out of buying Coles shares. They're highly correlated assets. Finding uncorrelated assets isn't easy though. For instance, a common diversification approach is to hold Australian and US shares. And whilst it's true that these markets don't move on a one-for-one basis, nonetheless, directionally, they're usually of the same mind. This is great when markets are going up, but it doesn't benefit your portfolio much when they're falling. Historically, bonds were used as the primary diversifier in a portfolio, with prices tending to be negatively correlated with stock markets. That's to say that if stocks go down, bonds go up. Unfortunately, in the past decade or so, that relationship has not been witnessed. Perhaps it will again in the future. My suspicion is that it will, but there's no guarantee. So then we look for other assets that might produce diversification. Gold is one popular example. Gold doesn't produce any income and has little in the way of practical use beyond jewellery, which is a discretionary item. But nonetheless, it does tend to move in price reasonably independently of what's going on in stock markets, and so it can add diversification benefits within a portfolio. It's within this train of thought that the potential for owning Bitcoin within a portfolio might have application. To be clear, our current stance here at Guidance with respect to Bitcoin exposure is that we're neutral. We're not currently actively recommending people obtain Bitcoin exposure. However, where our clients express a desire to hold it, we're not talking them out of it either. It's possible that Bitcoin is found to be completely worthless at some point in the future. But to ignore the potential that it might also have a role to play as a diversifier in exactly the same way that gold has done for hundreds of years is, I believe, a form of arrogance. Long-time listeners will know that I own a small amount of crypto assets. I hold a basket of Bitcoin, Ethereum, and Solana. I spent a bit less than $10,000 in 2021, and the deal I made with myself is that I'd sit on them until 2031, so 10 years, and just see what transpires. My train of thought has always been that if they went to zero, look, losing that amount of money, it's not going to jeopardise a roof over our head or food on the table. But on the flip side, if their adoption did really take off, well, there's the potential for some large gains to be made. Right now, the value of these little dabbles is quite a bit up on what I put in, which makes me happy, but, that could all evaporate next week. Who's to know? I'm not selling. 2031's the date that I'm holding onto them for. It's 7 years away, so I don't really care. The reason for sharing this, though, is to suggest how you might want to consider having exposure, if it's something that you'd like to do. Holding large chunks of your savings in assets like Bitcoin is, I think, unwise, in just the same way that it would be unwise to hold large portions of your wealth in gold. But that doesn't mean there's not a place for you to have a small allocation, probably between 2 and 5% of your portfolio. As investors, we receive returns as compensation for accepting risk. Buying Bitcoin is a risk, but if we take no risks, we generate no returns. The balance to be found then is the appropriate level of risk for your circumstances. With regards to how to go about getting exposure to Bitcoin, there are exchange-traded funds now that can sort you out here. There are nuances between the Australian and the US versions, with the US versions I understand having some benefits. But that said, unless you've already got a US trading account, I can't imagine that the technical benefits would outweigh the inconvenience of operating a US dollar account and having to deal with their horrible tax system and all its weird and wonderful forms. For most of us then, the version available on the ASX would suffice. Now, when I purchased my exposure, that option didn't exist, so I hold them direct. I must say, I find this pretty painful, and despite my best efforts, I'm pretty sure that if I was hit by a bus tomorrow, my family would never manage to figure out how to get a hold of these things and sell them. So certainly, if I was starting afresh today, I'd go down the ETF route. Bitcoin's had a fresh wave of energy since Donald Trump's election win, and I've certainly had quite a few questions from clients. We're all susceptible to a bit of FOMO after all. Hopefully, sharing these thoughts will help you decide what makes sense for you. Remember, investing is about taking risks. If we take no risks, we get no return. But taking too much risk and you could permanently destroy your capital. So the key is finding the balance that's right for you. Thanks for listening, and bye for now.